The information contained in this podcast is an expression of opinion and does not constitute investment advice. This is the GoldMoney Foundation podcast with Alasdair Macleod, keeping you up to date with expert opinion on precious metals and the markets.
Hello, this is Alasdair Macleod on behalf of the GoldMoney Foundation, and I'm pleased to say I have with me James Turk, who is the director of the GoldMoney Foundation. And we are attending a conference organized by the European Ludwig von Mises Institute in Brussels. And the subject that we're talking about today is the banking system, how we might bring in a new gold standard. We're talking about free banking, the problems of fractional reserve banking, and also a solution for the Eurozone crisis. So it's very, very wide-ranging. James, welcome, and it's very nice to have the opportunity to see you again.
Thank you, Alasdair. So it's a pleasure to speak with you.
Now, you're speaking here today, obviously the subject is very much sound money, and gold is such an important part of that. What basically will you be talking about today?
Well, I'm going to do a couple of things. The discussion is mainly going to be centered around the gold standard, and most people might think that I'm in favor of the gold standard, but in reality, I'm not. And the reason is that when you have a gold standard, you're basically talking about a monetary system which is controlled by governments and central banks. I mean, that was the gold standard that was invented, created by Sir Isaac Newton back in 1700, when he laid out the rules for the classical gold standard. And, that the rules that he laid out worked very well as long as they were followed, which they were followed for a couple of hundred years. But after 1914 and the outbreak of the First World War, when monetary system was reestablished after the war, the governments moved further and further away from the gold standard. And ultimately, we've reached the system that we have now, which is fairly well dominated by governments and by central banks. So I guess the point I'm making is that, first of all, gold is always the standard. It is always the numeraire by which goods and services are measured. It's sort of the natural form of money that has served mankind for 5,000 years. And it still does that in the sense that gold is very useful for economic calculation. For example, an ounce of gold still buys the same amount of crude oil it did 60 years ago. That's very useful in terms of understanding from a businessman's point of view, for example, how to make investments. It's also very useful from a family's point of view in terms of budgeting, where they should be saving and how they should be saving. So what I'm in favor of is gold reestablishing its role as money, but not in terms of any link to national currencies. I'm in favor of gold once again circulating as a form of currency, which it hasn't done for several decades, and moving away from money substitutes, which are the various national currencies that we have in circulation today. And I think the way that this could be brought about is ultimately through competition of currencies. Open up the market, let the forces of the marketplace provide a variety of different products, and let the market choose which form of money and currency they would like to use.
So if I understand you correctly, putting it another way, I think what you're implying is that money should be something that comes out of the private sector, if you like, the free market economy, rather than something that is fiat from the government and dictated to us.
Yes, that's exactly right. There was a German economist at the beginning of the 20th century by the name of Friedrich Knapp, who sort of turned monetary theory on its head. For the previous, thousands of years, it was always seen that money was something that came from the market process itself. It was a service that the market would choose which particular form of money they would want. And more often than not, it was gold and silver. In extremis, other things would be used, seashells or wampum or after war, cigarettes, tobacco in colonial Virginia. But at the end of the day, the market always chose money or silver as the supreme form of money par excellence. But what Knapp was saying is that money comes from the government, and money is not really a market-oriented service. And that's completely turned completely turned monetary theory on its head. And that was sort of the dominant theme of the 20th century. And it's still very prevalent today. For example, an article that Warren Buffett recently wrote in Fortune magazine said that the value of money comes from governments. That's very much a modern theory of money. It's not the classical, what I would call the true theory of money, which is that money comes from the market process itself.
So Warren is a modern George Frederick Knapp, unlike his father, who was a sound money advocate.
Yeah, exactly. In fact, I just wrote an essay on this for the GoldMoney Foundation. I was motivated by Warren Buffett's article in Fortune, and having been familiar with the speech that his father had given back in 1948 when he was a four-term congressman from Omaha, I sort of analyzed and compared those two different things to make some basic conclusions. And one of those conclusions was that to truly understand money, you have to read both Buffett's, not just Warren. And if you had to rely on only one, I would probably rely more on Howard Buffett rather than Warren Buffett. But Warren Buffett does give a good example of, what is the modern theory of money today. The interesting thing is, will this modern theory of money prevail for much longer? I think not. We've had a 40-year experiment now of fiat currencies backed by nothing except government promises and circulating because of government force through regulations and things of that nature, legal tender laws and that sort of thing. And we can see that the experiment with fiat currencies is going very badly. The governments are struggling to try to keep this game going a little bit longer. People call it kicking the can down the road. But as I often said, that can is not a can anymore. It's a 2-ton boulder. And it doesn't really get kicked very well these days. And so I think something major is happening. And in the monetary system, and as a consequence, we're going to go through what's happened many, many times in history. Attempts to make paper currency circulate eventually are doomed, and this time around would be no different in my expectation. And more to the point, you go back to basic principles in any kind of a catastrophe on the monetary side, and one of the basic principles is that gold has been money for 5,000 years, and I think it's going to remain money for the foreseeable future.
I was also very interested, James, in your bringing up the subject of George Knapp, because, of course, in his time, he was advising that money was a product of the state, and this was used by Bismarck to finance the First World War. And it was also subsequently used after the First World War to finance reparations, to finance basically a collapsing economy. The results were a hyperinflation. If I can tie that in, there is something I believe called modern monetary theory, which seems to me to be very, very close to what George Knapp was recommending with his chartalism, which was the school that he represented. Do you think it's just coincidence that here we are, some 80, 90 years later, having gone full circle back and having the apologists, if you like, for expanding money as the result, as the answer to everything, in exactly the same way as George Knapp did? And do you think that we're likely to have the same sort of conclusion that Germany had, an intractable inflation problem resulting?
Yeah, I'm of the view that hyperinflation is inevitable as long as we keep moving in this one direction. Hyperinflation manifests itself in different ways depending on the nature of the economy. In Weimar Germany, they were a cash currency economy. Almost all commerce was done with paper. Very few people had bank accounts. In contrast, Argentina in 1991 was a deposit currency economy. Almost everyone had a bank account. Very little commerce was done with paper. Commerce was done with banks by using checks, wire transfers, plastic cards. But both countries had hyperinflation. The U.S. has a sophisticated banking system, and what we're doing in the U.S. is the same thing that happened in Argentina. The government is borrowing too much money, more than the market is willing to lend to it, which means that the central bank either has to say, no, you're not going to have the dollars to the government, or they're going to run the printing press or the computer, is the case of Argentina. And today, and quantitative easing is running the computer. And we're seeing this not only in the United States, but in Europe, with the euro, with the Bank of England, with the British pound. We're seeing it in Japan. And ultimately, we're on the road to hyperinflation.
Yes, and I think the point about printing money to finance government deficits is very, very interesting, because I remember an earlier period when the Labour government tried to do that in the 70s, and every now and then the markets would turn around and say no, not at this interest rate. And we had something that we called the Grand Old Duke of York strategy. The Bank of England would have to run up interest rates to the level where they cleared the market. And the level of interest rates was really sometimes quite horrific. And these are interest rates that would definitely break governments now because there is so much more debt around. So I can't see where this end game is going to go. How do they get off this? Are we already in a debt trap whereby they're committed to so much more printing that it's going to be crisis first, solution second, rather than there is the room for a solution before we have that final monetary crisis?
Yeah, there's always room for a solution. It's not going to be an overnight solution. It's something that you put together as a plan and aim to complete it over a period of, say, 5 years or 8 years. I mean, the United States did this once before after the Civil War. They had a 10-year plan to go back onto a gold standard, and everybody worked toward that plan, and 10 years later, they went back on the gold standard as planned. So there's always a solution. It's always going to involve gold. But my expectation is that we're going to see the crisis first rather than the solution first. And I think that's what everybody has to prepare for. And, the bottom line I've been fond of saying is that everybody has to be their own central bank, because you can't rely on central banks to do the right thing anymore, which means you have to own gold, you have to own silver if you're so inclined, in order to protect your wealth until we get through the other side of the valley. And then you'll be in a position from the savings of these precious metals to, invest, purchase consumer goods or whatever, but your purchasing power will be preserved.
And presumably in holding gold and silver, you would recommend that you actually either physically hold it or hold it outside the banking system. What's your view on ETFs, which I think there's something like 1,400 tons held in ETFs now?
Yeah, supposedly, because you never really know whether the gold is there or not. It comes down to something very simple. There are two types of gold. There's paper gold and there's physical gold. Paper gold comes in a variety of different forms. ETF is one form, options, futures contracts, certificates, and all of these various things. But at the end of the day, when you own paper gold, you have counterparty risk. You don't own gold. You own exposure to the gold price, and that exposure is based on someone's financial ability and willingness to make good on their commitment to you when you ask for them to do that. And that's different than owning physical gold. If you're a speculator or trader and you want to speculate on the price, okay, consider ETFs or futures contracts or options. But that's really not from,
that's not what we're talking about.
No, that's not what we're talking about. And that, that's for the small minority of the people who are speculators and professional traders. For the vast majority of people, what you really want to do is own physical gold. And there are only two ways to do that. You buy it and store it yourself, or you buy it and have someone store it for you, which is obviously what GoldMoney does. And I'm in favor of doing both. Each alternative has advantages and disadvantages, and what every individual has to do is weigh those advantages and disadvantages to determine what's the right mix for them.
And a final topic, the interventionists who don't understand gold, don't believe in gold, want to deny its role and all the rest of it, seem to be keen to tell us that gold is in a bubble. Very briefly, your views on that, please.
Well, a lot of these people are the same people who are saying gold's been in a bubble for years and years, but nevertheless, gold is up 11 years in a row against the U.S. dollar, and this is the 12th year. There's a key point to keep in mind. There's a difference between price and value. Right now, gold's price has been climbing, but it still remains undervalued because of the debasement that's taking place around the world by governments and central banks. So, gold remains undervalued. It's not in the bubble. We're far from any kind of overvaluation level. My long-term forecast is $8,000 an ounce in 2013 to 2015. I think that's still a reasonable target. But given the amount of money printing that's going on now, I'm not even sure 8,000 would be an overvaluation when we finally get to that level. So focus on value. Don't worry about price. I like to compare it back to 1983 when the Dow finally broke above 1,000. And people said at 1,100 it was in a bubble, at 1,200 it was in a bubble. But what they were forgetting, again, was, over 20 years when the Dow was under 1,000, a lot had changed. The Dow had become very undervalued. So even though the price was going up, the value was definitely there. And that's the same thing right now with gold and silver, too, for that matter.
Yes. I think also the other thing that the people who would like us believe that we're in a bubble are actually ignoring is the emotions behind the market, because a bubble, by definition, is something when everybody is getting involved. The amount of involvement, certainly portfolio involvement in gold, is incredibly low. When we see gold being enjoyed, if you like, by a wider public in the way that the dot-coms were 12 years ago, then perhaps there may be a meaningful conversation. But even then, the reasons, and I think one of the things that you brought out, the reason for buying gold is not to speculate to make money. It is just to protect yourself, which is an entirely different thing. And when people are protecting themselves, it is not a bubble. A bubble occurs, I believe, when people go out there to speculate to make money in however they count it.
Yeah, that's exactly right. I see it the same way. When you're buying gold, you're actually saving money. You're saving some money. And, saving is an important part of a family budget. Saving for retirement, saving for a rainy day, saving for some consumer good you want to purchase in the future. We don't hear too much about it these days because it doesn't really make sense to save a fiat currency, given the way they're being debased and given all of the risks associated with fiat currency today. But accumulating gold, saving gold, that definitely does make sense. It has for 5,000 years, and that's going to continue to do so for the foreseeable future.
Well, James, thank you very much indeed for taking time to speak to me.
Thank you, Alasdair.
Subscribe to the Gold Money newsletter at www.goldmoney.com to receive email updates on new articles, videos, and iTunes podcasts from our Gold Research section.